Milk tea, a popular beverage that combines tea and milk, along with delicious chewy toppings, is evolving into multi-billion-dollar empires. As of now, 3 milk tea companies, Guoming, Mixue, and Auntie Jenny, have gone public with their initial public offerings, IPOs, on the Hong Kong Stock Exchange. In China, a standard cup of milk tea sells for about $5. However, after deducting the costs of ingredients, labor, advertising, and fixed expenses such as rent, electricity, and water, the profit shrinks to only about $1. The industry's profit margin is around 20%. So how can a business that earns only $1 per cup of milk tea sold at $5 grow into a billion-dollar industry, expanding from tiny shops to IPO that raise hundreds of millions, shaking up the Hong Kong stock market, and turning founders into overnight billionaires? How can these brands stand out in a crowded and fiercely competitive market? And as everyone rushes to expand globally, is the bubble about to burst? This story began in Taiwan in the 1980s. Bubble tea, also known as boba, is a blend of sweet, fragrant milk tea and chewy tapioca pearls. This sweet and refreshing drink, with the fun, chewy texture of tapioca pearls, quickly became a popular local beverage. As Taiwan's economy grew, so did its cafe and beverage culture. But it was mainland China that turned bubble tea into a modern-day gold rush. In the early 21st century, rising middle-class incomes and rapid urbanization fueled demand for more diverse beverages and lifestyles. Milk tea has become a beloved symbol of Taiwanese culture and identity, even inspiring the creation of a national bubble tea day. But it didn't stop in its homeland. Bubble tea has exploded across the world, reaching Southeast Asia, the United States, and even the Middle East. Globally, the freshly made beverage, FMB market, is a massive industry. In terms of market size, it reached $779 billion in 2023 and is expected to grow at a compound annual growth rate, CAGR, of 7.2% through 2028. In just the first 4 months of 2025, 3 bubble tea chains have stirred up the Hong Kong IPO market. In February, Guoming raised $232 million, but its stock price dropped 6.4% below the listing price on the very first day. Mixue raised $444 million and soared 47% immediately after ringing the bell. Auntie Jenny jumped 75% above its listing price, raising around $35 million on its May trading debut. Today, Mixue has over 46,000 stores worldwide, surpassing American fast food giants like McDonald's, Starbucks, and Subway. Starbucks, once considered the benchmark of coffee culture in China, is now gradually losing its foothold. Starbucks is not only facing competition from Chinese local coffee chains, but also from bubble tea brands that have started offering coffee or coffee-style beverages. That's why people often say that in China, the line between bubble tea and coffee is very thin. As coffee and bubble tea brands compete for the same customer base, the real battlefield will revolve around scale, pricing, and franchising. And that's when Chinese bubble tea chains are rewriting their business strategies. Mixue is the fastest-growing brand in terms of store openings. In 2024, they grew their number of new stores by about 22%, with nearly 100% of the stores being franchised. Mixue also targets price-sensitive customers, consumers who want affordable products without compromising on quality. They have taken this low-cost model beyond China's borders. Mixue's largest overseas markets include Vietnam and Indonesia, where the company has successfully priced lower than competitors and captured a significant share of the market. Auntie Jenny targets Tier 3 and 4 cities, expanding its stores at a rate of over 56%. Their product prices are slightly higher than Mixue's. Guming occupies the mid-range segment, pricing each cup at 1.5 to 2 USD and targets Tier 2 cities. Among the three brands, Guming has the slowest growth. The way these brands truly make money lies in their business models. Most of these brands don't operate their own stores. Nearly all of their locations are franchised. Franchisees must pay an initial setup fee, typically ranging from $30,000 to $80,000 US, depending on the country. They are required to buy ingredients from the brand's central supply system and pay ongoing royalty fees, either a fixed monthly fee or a percentage of the store's revenue. So how can this franchising model expand across borders, adapt to different cultures, and attract consumers worldwide? To understand why franchising has become the dominant model, let's look at what Gongcha, a bubble tea brand born in Taiwan, did to grow to over 2,000 stores across 28 global markets. Gongcha carefully mapped out the world to identify growth potential for its brand. First, they studied consumer demand and preferences, whether people would be willing to try their tea products. At that time, consumer trends were gradually shifting from coffee to tea, especially among young people. Gongcha's main target audience is smart young women under 30. This is a rapidly growing, frequent spending customer segment, enabling Gongcha to open stores in a new country and achieve strong business results. Second, they consider the complexity of the supply chain, whether it could ensure profitability for franchise partners. And the result is that by combining both factors, consumer demand and a profitable model, Gongcha successfully rolled out its franchising system. But the franchising model isn't always easy or guaranteed to succeed. While paying royalties to the company, franchisees often bear the burden of high rent, fierce competition with industry rivals, and very thin profit margins. When too many franchise stores pop up, maintaining a consistent customer experience across locations becomes increasingly difficult. The average payback period for franchisees is 18 to 24 months, and the closure rate for franchise stores is around 20%. Another issue with this model is the distance between franchise stores of the same company. Some store owners are further squeezed when a new outlet opens just a few meters away. In some areas, multiple Mixue stores are located on the same street, just 200 meters apart. As a result, online complaints have surged, with store owners criticizing the parent company for prioritizing expansion over franchisee profitability, shifting risks onto small business owners. As business owners, they face intense competition from another store right next door. Since the products are similar, the only differentiators are service, quality, and staff attitude. The success of these bubble tea brands increasingly depends on the strength of their supply chains. Take Mixue as an example. The company is structured more like a supply chain business than a traditional tea brand. The company's revenue primarily comes from selling raw ingredients, components, packaging, and equipment to franchisees. Mixue states that they produce 60 to 100% of their ingredients themselves and maintain a massive procurement network across 38 countries, enabling faster supply and lower costs than competitors. They also have their own delivery and warehousing system. This supply chain model helps the company reduce costs and maintain healthy profit margins. While franchising creates market coverage and reach, it's word of mouth and flavor that spark the real craze. This isn't just tea, it's your own tea. You can customize everything. Sweetness levels around 50% or 70%, ice amount, various toppings, and different tea bases. Bubble tea has brought local and regional flavors to different markets. Matcha in Japan, taro in Taiwan, palm sugar in Malaysia, and even durian in Singapore. So even if you're in one country, you can enjoy flavors from all over the world. Just search the hashtag #bubble tea on Instagram, and you'll find over 4 million posts using it. This has helped bubble tea become globally popular. Mixue's mascot and viral jingles have helped the brand reach consumers without relying on expensive advertising. In contrast, Hey Tea and Mixue focus on limited edition products, premium packaging, and brand collaborations. These brands continuously innovate in connecting with customers through loyalty programs, delivery-only stores, and even bubble tea making robots. But how long will this craze last? Even as new stores keep opening, many are also closing. According to China's state media outlet, Securities Times, Mixue, Auntie Jenny, Guming, and Chapanda had store closure rates ranging from 4.2% to 11.4% in 2024. With too many chains crowding the market and similar menus across the board, some bubble tea chains have had to close stores due to overexpansion, intensifying competition for market share and pricing. The next frontier may not be opening more stores, but upgrading to premium offerings, creating health-focused beverages, or even AI-assisted tea shops. The only question now is, who will survive the next wave? What do you think? Share your thoughts in the comments below. If you found this video interesting and helpful, don't forget to like and subscribe to our channel to join us for more videos.